Right, here we're going to look at financial statement analysis, and we will look at three things in the financial statement analysis: vertical analysis, common size financial statements, which are an example of vertical analysis, and we'll also look at horizontal analysis. So financial statement analysis is obviously about analysing the financial statements. So let's start by putting some financial statements together. So firstly, there's the income statement, and just a reminder that the income statement is sales less cost of goods sold equals gross profit less expenses equals net profit. So that's the income statement. Let's put a few numbers in there. So we'll have sales 200, cost of goods sold 60. That would leave gross profit of 140. Then less expenses of 50 would equal net profit of 90. Then we'll look at the balance sheet. Let's make this a little bigger, and I'll probably make it a bit smaller because I'll run out of room. So balance sheet is current assets plus non-current assets, and obviously there's all the different items within the current assets and the non-current assets, which equals total assets. And then we have current liabilities, non-current liabilities, total liabilities, and then we've got owner's equity, and we have the total of liabilities and owner's equity. So current assets, let's say 160, 340, which gives us total assets of 500. Then we have current liabilities of, say, 120, non-current 180. That would give us total liabilities of 300. And I guess then we can tell that our owner's equity is going to be 200. So the total of owner's equity and liabilities is 500, and our balance sheet balances. Now, this puts us in the position to start vertical analysis. What's vertical analysis? Well, we go down vertically, and we express items as a percentage. Now, what do we express them as a percentage of? Well, in the income statement, we express items as a percentage of sales, and in the balance sheet, we express items as a percentage of total assets. And now we're going to express each of these items as a percentage. So the sales is, we express everything as a percentage of sales, so 200 divided by 200 is clearly going to be 1 or 100%. So expressed as a percent. Then 60 divided by 200 is going to be 30%. So 0.3 and expressed as a percentage 30%, or multiply the 0.3 by 100, 140. 140 divided by 200, and we've got 70%. And then we have 25%, 50 divided by 200, so 1/4. So 1/4, 0.25, or expressed as a percentage, 25%. And finally we'll end up with 45 when we divide 90 by 200. So 0.45, or expressed as a percentage, 45%. So instead of just expressing as a percentage, I could have gone 0.45 and multiplied that by 100. Now in the balance sheet, everything is expressed as a percentage of total assets. So total assets is going to be 500 divided by 500, which is 1, or 100%. Now we go back to current assets, will be 160 divided by 500 will be 0.32. And if I can catch it back, 0.32 or 32%. And we know that current assets will have to work so that it's going to be 68% to add to 100, so equals 340 divided by 500, 60.68, expressed as a percentage, 68%. Now look at liabilities, 120 divided by 500, and that's 24%. 180 divided by 500, and that's 36%. So we'll add those two of those together, and we'll see that total liabilities are going to be 60%, or 300 divided by 500 equals 0.6, or 60%. Now this ratio here, total liabilities over total assets, is also referred to as the debt ratio. What portion of your income, what portion of your assets are funded by debt. And now we get into equity, and we've got 200 divided by 500, that's 0.4, or 40%. And clearly 500 is 100%. I should have put 1 in here, shouldn't I? Yep. 500 is 100% of 500. So that is your vertical analysis. So what does vertical analysis do in terms of your income statement? Well, it tells you where your money's going. So 30% of your money is going in cost of goods sold. That leaves 70% for profit, then for gross profit. Then another 25% are going in expenses, which leaves 45% for net profit. Now obviously we're just doing these in very simple income statement, but vertical analysis will involve each expense category. With the balance sheet, it gives you an idea of how your assets are funded and then what they're represented by. So we can see here that assets are funded by current liabilities 24%, non-current liabilities 36%, and owner's equity by 40%. And of our assets, 32% of them are current and 68% are non-current. Now, that's a starting point. Let's take this just one step further. And here we have sales, and I'll do a different business this time. And let's say we have sales of 1,000. We have cost of goods sold of 700, which equals a gross profit of 300. Expenses 180, which leaves us gross equals net profit of 120. Balance sheet, let's say we have let's say 200,000 current, non-current 800,000, giving us total assets of 1,000. Current liabilities, let's say 420. Non-current liabilities 180. Total liabilities 600. for owner's equity is 400, and total liabilities and owner's equity is 1,000. Now, and I'll work on this side this time, but again we will do vertical analysis for this business. So we can see sales, 100% of sales. That makes sense. 100 equals this number divided by this number. Express that as a percentage. Now we're going to divide everything by G3. So sales are 100%, gross profit we'll see as 70%, cost of goods sold 70, and we'll see that gross profit is 30, expenses are 18%, and net profit is 12%. And in terms of the balance sheet, we want to express everything as a percentage of total assets. So clearly total assets will be 100% of total assets. And we'll make this an absolute cell reference, so I can just copy these around. And then current assets is 20% of total assets. Non-current assets is 80%. Current liabilities is 42%. Non-current liabilities 18%. And total liabilities 60%, which is the same as this business over here. And owner's equity 40, and total is 100. Now, vertical analysis we've done for business 1, vertical analysis we've done for business 2, and that leaves this bit in the middle, what's referred to as common size financial statements. Then we can have some comparison of these two businesses. So we can see this business has a much higher cost of goods sold than this business. So obviously it's then going to have a lower gross profit. Expenses are lower, but one of the reasons they are lower is because so much of the money's gone into cost of goods sold, and net profit is much lower. So there we can compare. Instead of comparing 200 to 1,000, we compare 100% to 100%. Instead of comparing $60 cost of goods sold to 700, we go 30 to 70. And here's one of those areas more telling. Instead of this business having a gross profit of 300 compared to this one of 140, so more than twice as much, but in percentage terms it's only half as much. Now these businesses are really different. They're doing this analysis with businesses that have some of these percentages a bit closer, in a sense maybe more meaningful. Now let's look at some other things we see. This business, it's funded by much more non-current assets than current assets. Now, is that an issue? Well, apart from just comparing these two businesses, we can also see here that current liabilities are 42% of total assets compared to current assets of 20%. So in part of the analysis you'll do later on, you've identified some issue there. In terms of liquidity, this business will probably have some issues. Now, just as a recap, vertical analysis is looking at the business in its percentage terms. So for income statements, in percentage of sales, for balance sheet, it's percentage of total assets. Common size financial statements is when you compare the two businesses expressed in terms of their vertical analysis. Let's go one step further now and look at horizontal analysis, and I'll take this business over here. And let's say this was the year 2010, and now let's look at 2011. So let's say in 2011 sales were 1,200, cost of goods sold 800, gross profit is 400, expenses 200, and net profit 200. So unless they've had a distribution, we would know that owner's equity would go up to 600 because we've made a profit there. So let's see what else might happen. We might go 300 current assets, 900 total assets. That would be 1200 total assets, 900 non-current assets, 1200 total assets. That would then mean that liabilities would have stayed the same. I'll put them in the same proportions. Righto, now we get on to horizontal analysis. So vertical analysis will look down, horizontal analysis goes across. And horizontal analysis is also often referred to as trend analysis. So what can we do here? We could do a few things. We could do how much has the business improved or increased. So we can see here it's increased over the base year by $200 in sales, $100 in gross profit, in cost of goods sold, $100 gross profit. The expenses have only gone up $20, and net profit therefore has gone up 80. So we look at the increase. That's one way of doing a trend analysis. Year on year, comparing year on year. And we could do the same down here. See, current assets have gone up 100, non-current up 100. Total assets have gone up 200. None of the liabilities have changed, and equity has gone up 200. So that's one way to do it. Another way we could do it is in terms of percentage increase. So what's the percentage increase? Well, we've got the increase is 1200 minus 1100, so which is 100, and divided by 1000. So expressed as a percentage, so we have a 20% increase in sales. We have a 14% increase in cost of goods sold. That's good. Our sales are rising more rapidly than our cost of goods sold, which will mean our gross profit has gone up at a much faster rate than our sales. So that's a good trend. This is a trend analysis. Our expenses have gone up 11% compared to sales of 20%. So we are going to expect a good increase in profit, which we've got 67%. So we see from a 20% increase in sales, and from keeping control of cost of goods sold and expenses, we've got a substantial increase in profitability. What's happening to our assets? Our current assets have increased 50%, non-current 13, total assets 20. There's been no change in our liabilities, and our equity has gone up 50%. Now that is an example of trend analysis in terms of horizontal analysis. So what do we have here? We have vertical analysis. Did two examples of vertical analysis. Then when we compare those, they become common size financial statements. And then when we look at a business over time, we have horizontal analysis, which is also known as trend analysis.